Welcome back to the Iraqi Dinar Info channel, your most trusted source for real-time RV updates, global financial resets, and insider news on the DAR, Dong, ZM currencies. Flash alert investors. A massive banking system reboot is underway right now, and the clock is ticking. Signals are pointing toward a shocking rate flip for both the Iraqi Dinar IQD and Vietnamese Dong VND, possibly within hours, not day. Are you prepared? Have you secured your currency? Have you aligned your documents and appointment strategies? Stick with us to the very end, because what we're about to reveal may transform your life forever. Let's dive in. The term bank system reboot has been circulating widely in financial circles, media discussions, among investors who are closely tracking the evolving monetary landscape. But what does it truly mean beyond the catchy phrase? At its core, banking system reboot is not simply about a single bank updating its software or improving its security. Instead, it refers to a globally coordinated set of information technology upgrades being executed by Tier 1 and Tier 2 banking institutions, often in synchronization with both central banks and national treasury departments. These coordinated upgrades involve more than maintenance. They are linked to the restructuring of entire payment protocols, clearinghouse operations, and foreign currency databases. When systems are taken offline for what appear to be short maintenance windows, they often return with changes that are invisible to the general public, profoundly consequential for how money moves across borders, how foreign exchange is calculated, and how settlements are recorded in real time. The phrase reboot is therefore being used not as a casual metaphor, but as an indicator of a deliberate resetting of the global financial operating system, one that appears to be structured around new rules tied to asset-backed systems rather than debt-leveraged fiat arrange. This orchestrated activity, especially because it is occurring across multiple nations, simultaneously signals a level of coordination that suggests more than simple patching or incremental updates. It indicates a structural reset that has implications for currency valuation, wealth distribution, international trade settlement. When financial insiders and informed observers speak of this reboot, they often highlight that its execution is not random nor confined to regional actors. Instead, it is being carried out in close partnership with government-level financial authorities, and including national treasuries and central banks, which are the backbone institutions that define monetary policy. Such high-level orchestration suggests the reboot is not simply an IT event, but rather the preparatory stage for introducing a new kind of monetary architecture according to individuals with ties to banking operations. One of the main reasons for this complex process is the need to prepare infrastructure for the launch of a new global asset-backed financial system. The fiat-based system that has dominated since the dissolution of the Bretton Woods Standard in the 1970s. The proposed system ties currency values to tangible assets such as gold, oil, minerals, or sovereign reserves. This requires recalibration at the digital core of banking networks because databases, liquidity models, and payment systems must now recognize not just fiat valuations, also new rates tied to asset holdings. Central to this discussion are the currencies believed to be scheduled for revaluation, including the Iraqi Dinar IQD, the Vietnamese Dong VND, and the Zimbabwe dollars. These currencies, often dismissed in traditional finance as unstable or heavily depreciated, are anticipated to return with dramatically altered exchange rates under the asset-backed paradigm, which is why the banking reboot is not merely technical, but transformative. Ian, to understand why many analysts and insiders are paying heightened attention to the concept of a rate flip, is first essential to define what this term means in the context of the current financial transition. Flip refers to the sudden and decisive adjustment of certain currency exchange rates, most notably the Iraqi Dinar, IQD, Vietnamese Dong VND, away from artificially suppressed values toward their recalculated international worth under an asset-backed system. Unlike minor daily adjustments on Forex markets, which are influenced by supply-demand dynamics, central bank announcements, or short-term geopolitical events, flip is a structural correction designed to reflect deep shifts in how the value of a currency is pegged to real-world assets. The importance of this concept lies in its transformative nature. Once a rate flip occurs, the entire framework for valuing and trading that currency in the global system changes almost overnight, creating ripple effects for importers, exporters, investors, and government. For decades, rumors of a potential revaluation of currencies, such as the dinar, have circulated. This moment differs because of tangible signals from the banking infrastructure itself rather than speculation alone. Evidence points to system-wide preparations, liquidity testing, and banking screen resets that can only logically precede a significant recalibration of rates. Reflip. The imminent rate flip is therefore not just another theory, it is the conclusion drawn from a sequence of observable, viable banking actions that are difficult to dismiss as mere coincidence. Several key developments strengthen the argument that this moment is categorically different from previous cycles of speculation. First, liquidity tests have already been conducted across multiple tier 3 banks, simulating movements of capital on a scale involving trillions of dollars with a particular focus on the flows connected to dinar and dong transactions. Stress tests of this magnitude are neither common nor performed without reason. They strongly suggest preparation for extraordinary liquidity events linked to revalued currencies entering circulation. Second, U.S. Tier 1 banks have recently undergone a purge of outdated rate tables, followed by the installation of dynamic Forex display systems capable of updating in real time to reflect sudden large-scale changes in rate structures. This move indicates foreknowledge of dramatic adjustments rather than routine market volatility. Third, Iraq's central bank CBI has halted its public currency auctions that historically has preceded significant shifts in policy, such as redenomination or revaluation. Finally, parallel developments in Vietnam have drawn attention as officials have been holding closed-door meetings regarding currency stabilization for international competitiveness. Phrase that in insider language often signals preparations for controlled rate adjustment. Taken together, these steps reflect not rumor but groundwork.